After a week of impressive gains, Wall Street is taking a breather. The energy that fueled the markets over the past several days has given way to a more measured tone as investors pause to reassess their positions and digest the latest developments. This moment of reflection comes after a period where optimism seemed to dominate trading floors, with many hoping that the good times would continue. As U.S. stock futures edge slightly lower to start December 2025, the mood is noticeably more cautious. The slight dip in futures is not dramatic, but it does signal that traders are becoming more selective and perhaps a bit wary after such a strong run. The red numbers on the screens are a reminder that markets rarely move in a straight line, and that even in bullish times, pullbacks are part of the natural rhythm. Last week, the S&P 500, NASDAQ, and Dow all posted significant increases, fueled by hopes that the Federal Reserve may soon cut interest rates. Investors were encouraged by signs that inflation is cooling and that the central bank could pivot to a more supportive stance. This optimism drove a wave of buying, pushing major indices to new highs and sparking talk of a potential year-end rally. This minor dip in futures is a typical pause after a rally, as investors shift focus from recent triumphs to upcoming economic and political events. It's a moment to catch their breath, reassess risks, and consider what might come next. The market's mood can change quickly, and after a surge, it's not unusual to see some profit-taking or hesitation, as traders weigh the potential for further gains against the possibility of setbacks. The S&P 500 futures, along with NASDAQ and Dow, are down just a fraction, signaling a more cautious mood. While the declines are modest, they reflect a market that is no longer running purely on optimism. Instead, investors are looking for new catalysts, fresh data, policy announcements, or earnings reports that could justify another leg higher or warn of trouble ahead. The market is now watching for concrete news on interest rates and the next Federal Reserve chair, two factors that could set the tone for weeks to come. The Federal Reserve's decisions have a powerful impact on everything from borrowing costs to corporate profits, and any hint about the direction of policy is closely scrutinized. The upcoming announcement about who will lead the Fed into 2026 is also adding a layer of uncertainty, as leadership changes can influence the central bank's approach to inflation, growth, and financial stability. Investors are scanning the landscape for clues, aware that last week's optimism could quickly turn if expectations aren't met. They're poring over economic reports, listening to central bank officials, and debating what the next move might be. The mood is one of cautious anticipation, as everyone tries to position themselves for whatever surprises the market may have in store. The big questions: will the Fed deliver the expected rate cut, and who will lead the institution into 2026? These decisions will shape not just the next few weeks, but potentially the entire trajectory of the market heading into the new year. For now, Wall Street waits, watches, and prepares for the next chapter in this ever-evolving story. To truly grasp the mood on Wall Street, it's essential to understand stock futures. These are financial contracts that obligate the buyer or seller to purchase or sell a market index, like the S&P 500, at a predetermined price on a specific date in the future. Stock futures are not just abstract financial tools, they're a vital part of how the market anticipates and reacts to upcoming events, economic data, and global developments.
Think of stock futures as the market's weather forecast. Just as meteorologists predict storms or sunshine, futures give investors an early read on how the market might open each day. Before the opening bell, traders and analysts closely watch futures to gauge investor sentiment and prepare for what's ahead. This early insight can influence everything from trading strategies to news headlines.
Unlike regular stock trading, which is limited to standard market hours, futures trade nearly 24 hours a day. This round-the-clock activity means investors can react instantly to breaking news, international events, or economic reports, no matter the time zone. As a result, futures provide a real-time gauge of how investors feel about the market's direction, even when the main exchanges are closed.
If futures are up overnight, it's often a sign that investors are feeling optimistic, and you can expect a positive start to the trading day. This optimism might be driven by strong earnings reports, positive economic data, or encouraging news from overseas markets. On the other hand, if futures are down, as they are now, it signals caution. Investors may be worried about potential risks, disappointing news, or uncertainty about what's coming next.
The slight dip in futures this morning suggests the market is taking a moment to pause and reassess. After last week's surge, investors are catching their breath, weighing whether recent gains can be sustained or if a pullback is on the horizon.
By watching futures, we can track the market's evolving story in real time. Futures prices are shaped by everything from global news headlines to speculation about what the Federal Reserve might do next. They help investors stay ahead of the curve and adapt quickly to new information.
This morning's decline in futures reflects a market that's carefully weighing recent gains against the risks that still lie ahead. Investors are especially focused on the Federal Reserve's next move, as any change in interest rates or policy could have a major impact on the market's direction in the days to come. The market's rally, and its current pause, centers on growing expectations of a Federal Reserve interest rate cut.
When the Fed cuts rates, borrowing gets cheaper for businesses and consumers, usually boosting economic activity and stocks.
For months, the Fed held rates steady to fight inflation. But now, dovish comments from Fed officials have shifted sentiment.
Recent remarks from key Fed leaders hinted that slowing inflation and a moderating job market could soon justify a rate cut.
These signals have fueled optimism, making stocks more attractive as investors bet on easier monetary policy.
The hope for a rate cut is now a calculated bet, not just wishful thinking.
The focus has shifted to the Fed's upcoming meeting, where investors expect a pivotal decision. Dovish Fed comments have triggered a dramatic shift in market expectations for a rate cut.
Just a week ago, the odds of a December rate cut were about 45%. Now markets see an 85% chance.
This rapid change has powered the recent stock rally as investors rush to position for lower rates.
Every word from the Fed is scrutinized, and this shift shows how sensitive markets are to central bank signals.
When everyone bets on the same outcome, any surprise can cause major volatility.
If the Fed doesn't cut rates as expected, stocks could see a sharp sell-off.
The market is holding its breath, hoping it's read the signs correctly. The upcoming Fed meeting is now one of the year's most anticipated events. Adding to the uncertainty is the search for the next Federal Reserve chair, as Jerome Powell's term ends.
President Trump has announced he's made his choice, raising anticipation for the official nomination.
The Fed chair is the world's most influential economic policymaker, and their stance will shape markets for years.
The president wants a chair who supports rate cuts to stimulate the economy, adding a political twist to the decision.
Investors are watching closely, knowing the new chair's approach could tip the balance between growth and inflation control.
The chair leads the committee that sets rates, holding immense sway over policy direction.
The nomination will send a crucial signal about the Fed's likely path and could determine market winners and losers. Speculation is swirling around the shortlist for the next Fed chair, with names like Kevin Hassett, Kevin Warsh, and Christopher Waller in the mix.
Each candidate brings a unique background and policy bias, and Wall Street is analyzing their records for clues.
The key question: will the president pick a dove, someone who favors lower rates to boost growth?
A dovish chair would likely mean a friendlier environment for stocks, reinforcing current market expectations.
Analysts are dissecting every speech and paper from the frontrunners, trying to predict their moves under pressure.
A known dove like Waller could send stocks soaring, while a hawk or unknown could spark uncertainty.
The market is intensely vetting these candidates, knowing the choice could set the tone for years. Lower interest rates and a dovish Fed chair have a direct impact on your investments.
Rate cuts lower borrowing costs, letting companies invest, hire and grow, often boosting their stock prices.
Lower rates also make bonds and savings less attractive, pushing investors towards stocks for better returns.
This Tina effect, there is no alternative, drives money into the stock market when rates are low.
A Fed rate cut would reinforce this, giving stocks a strong tailwind and boosting investor confidence.
Companies with debt benefit directly, as lower interest payments mean higher profits and potentially bigger dividends.
The chain reaction is clear: rate cut signals, cheaper borrowing, more attractive stocks, and rising confidence. That's why even the expectation of a cut has sent markets to new highs. Some sectors, especially technology and retail, are especially sensitive to Fed policy.
For tech companies, lower rates boost the present value of future profits, making their stocks more attractive.
Retailers benefit as cheaper borrowing encourages consumers to spend more on big-ticket items and everyday purchases.
That's why both sectors led last week's rally and are closely watching the Fed's next move.
A dovish Fed could create ideal conditions for tech and retail to outperform in the coming months.
Investors are already positioning for this scenario, betting on continued strength in these rate-sensitive sectors. The rally in tech and retail stocks reflects expectations of easier money and stronger consumer demand. The Fed's decision could be a game-changer for these industries. As we wrap up, Wall Street stands at a pivotal crossroads, caught between the mounting hopes for a Federal Reserve rate cut and the uncertainty that comes with the prospect of a new chair. The financial district is abuzz with speculation, as investors and analysts alike try to decipher the signals coming from the nation's central bank. The stakes are high, and every move is being watched with intense scrutiny. The market's recent rally is built on the widespread belief that borrowing costs are about to fall, potentially unlocking new opportunities for growth and investment. This optimism is not unfounded. Dovish signals from the Fed have only strengthened the conviction that a rate cut is imminent. Traders are recalibrating their strategies, and financial institutions are preparing for a shift in the economic landscape. In just a week, the odds of a December rate cut have surged from 50% to 85%, a dramatic shift that has sent ripples through the markets. This rapid change in sentiment has emboldened investors, driving them into stocks and riskier assets in search of higher returns. The anticipation is palpable, and the sense of opportunity is matched only by the underlying tension. Now, all eyes are on the upcoming Fed meeting, where policymakers will weigh the latest economic data and decide the path forward. The chair nomination adds another layer of complexity, as the choice could signal a shift in the Fed's long-term approach to inflation, employment, and market stability. These two events, the Fed's decision and the chair nomination, have the power to either reinforce the current wave of optimism or send shockwaves through the financial system. Tech and retail stocks, in particular, are poised to benefit most if the Fed delivers on expectations, as lower rates could fuel consumer spending and innovation. But the risks are real. Any disappointment, whether from a surprise in the Fed's messaging or an unexpected chair pick, could trigger a sharp reversal in market sentiment. Investors are keenly aware that the line between euphoria and panic is razor-thin, and volatility could return in an instant. For now, Wall Street waits, watching for every signal from Washington and the Federal Reserve that could shape the market's direction as 2025 approaches its end. The next few weeks will be critical, as policymakers' decisions will determine whether this bold bet on lower rates and a growth-friendly Fed pays off or unravels, leaving investors to navigate a very different landscape. In this high-stakes environment, the intersection of policy and markets has never been more consequential. The outcome will not only define the closing chapter of this year, but could set the tone for the financial world in the year ahead.